Welcome to Credit Smart. I'm Mary Grace Diehl. I'm a bankruptcy judge here in the Northern District of Georgia in Atlanta, and my co-host is Sarah Mancini, who is an attorney with the National Consumer Law Center. And we are here today on behalf of CARE, which is Credit Abuse Resistance Education, a program, next slide, Sarah, which is a program that was started by a bankruptcy judge when he noticed that there were an awful lot of young people that were forced to file bankruptcy. So CARE now educates students about credit, how to use it responsibly, literacy skills, and the potential consequences of poor money management or credit card abuse. So stay tuned. It's time to get smart about credit. So we start with the basics. What is credit? Sounds like a positive thing. And it is. It's the ability to borrow money when you need it. But borrowing money creates debt. Debt is not such a good thing. And that's what you owe. And the basic story we're telling is it costs money to borrow money. So why should you care about this? Next screen. Credit is debt and it has to be paid back. When you pay something with a plastic card, you still owe the money, and too much debt could ruin your life, not just financially, but also from a stress or family standpoint. So let's talk about what it takes to get credit. And look at this from the standpoint, if a friend asks you to loan them some money, what are the things you think about? The first C is character. Is this person going to pay back the debt? Do they have a history of repaying debt? Capacity. Do they have a job? Do they have ability to pay back the debt? Do they have more income than expenses? And finally, in some circumstances, collateral, which is assets you can pledge. You think of this most frequently in terms of a car loan or a home mortgage. So character, capacity, collateral. We do have a short video that talks about the problems that you can get into from using credit cards.
So obviously a little bit of humor there, but I think one thing that's really helpful about that SNL skit is even though they're making it funny, this idea of, of course, don't buy something if you don't have the money, It can be really difficult. We grow up in a society where there's a lot of pressure to own certain things and have certain things, and credit cards make it all too easy to end up buying things that you actually don't have the money to buy. And so that's what we want to talk about in this next section here is, what are credit cards? How do they work? And why should you be careful about using credit cards? So there are some good reasons to have a credit card, and the things noted on this slide are some good examples. It's useful to have a couple credit cards in case there's an emergency in your life, or if you have to make a large purchase that's really important. Buying things online can sometimes be easier with a credit card, although you may be able to use a debit card. Credit history building, and safety and security of ensuring that you can prevent unauthorized charges, because using a debit card can be a little bit riskier in that respect. So there are good reasons to use a credit card, but there are also a number of downsides. First of all, if you rely too much on credit cards and end up actually carrying a balance on your credit card, it's very expensive. The interest rates on most credit cards are in the double digits. So 15 or 20% interest rate is not at all unusual for a credit card. And there can be additional fees, overdraft not overdraft, but over limit fees and late fees, things like that can really add up. Also, it is in a way very easy to spend money on a credit card. You just swipe the card. It doesn't feel like it has consequences sometimes. And so people can end up stuck in a debt trap from relying on credit cards and feeling like they don't actually have to have the money to be able to pay it back. And that can induce people into a situation that's hard to get out of. So we want to talk with you a little bit more about how credit cards work and how to avoid being drawn into that situation where it really becomes a debt trap. So it's important for you all to be aware of this, because above age 18, you may get credit card solicitations. There are some laws related to this in some states, but in general, there are credit card solicitations that will start going out, and so you want to know what to avoid before problems may arise or before making decisions that can have a long-term impact. So let's see what kinds of damage do you need to be worried about in this context. First, it's important to understand the difference between a debit card and a credit card. A debit card is actually like paying with a check. You are using money that you already have in your bank account and drawing that money out of your bank account directly to pay for things that you're buying. And when you use a debit card, you're not borrowing money from anyone. You're using your own money, so it doesn't help build up your credit score. But on the flip side, you're also not paying interest to use your own money through a debit card. Credit cards, on the other hand, allow you to purchase goods or services from a merchant or any company, and you are borrowing that money from the credit card lender. And in exchange for having that money loaned to you, you do pay interest and fees. Unless you pay off the card each month, paying off the balance in full, interest will start to accrue on that balance. And so you need to be aware of the interest rate on any credit card and how that amount can add up over time. And we're going to walk through an example of that. Interest is the amount that a lender charges as a condition of extending you a loan. So it is the cost of borrowing money. And here's a little bit more vocabulary. We can talk about lender or creditor. The lender is the person or company that originally makes a loan, and a creditor is really anyone that you owe money to. So sometimes loans get transferred. So you might take out a loan from an original lender, and then it might be transferred to a new creditor. Creditor is also broader because you can owe money to a creditor even if you didn't voluntarily take out a loan. But if you end up owing a debt to someone, that person is the creditor. So sometimes those two terms are interchangeable, but sometimes there is a difference. And the lender or creditor will charge an interest rate. The higher the interest rate, the more money you will pay to borrow that money. And the longer that it takes you to pay off the loan, the more interest you will pay over time. And really importantly, with credit cards, there's something called compound interest, which essentially means that if you don't pay off the interest within that month that the interest accrues, it will get added to the balance. And that means that the next month you'll owe more interest, because you're always going to pay interest on whatever remaining balance you owe. So ideally, you want that balance to be going down over time. But if you actually make a minimum payment that is less than the interest you owe that month, then the balance will grow and you'll owe even more interest the next month. And that's how compounding interest works. So let's go ahead and talk about an example of purchasing something on a credit card and how the interest works. Let's say you bought a new laptop for $1,000, but you didn't have the $1,000 in your bank right at that moment, and you decided that you could afford to pay $150 a month. So assuming that you had a pretty good credit score and your interest rate on this credit card was 15%. We talk about the APR, which is the annual percentage rate, which is pretty similar to the interest rate. There are some other fees that can be added in as part of the APR, but let's assume here that basically you're charged an annual interest rate of 15%. And again, you've decided to pay $150 a month. And in this example, you never miss a payment. You make that payment every month faithfully on time. So how much will it cost you to buy this laptop over time? And here's a hint. It's going to be more than $1,000. It's going to be more than the sticker price of this laptop, because you're actually going to pay money to borrow money. That's the message that we're conveying here today, is that the interest rate is the cost you pay for having that service of borrowing money in advance. And so there are calculators that you can find online to do the math. If you search for amortization calculator, an amortization calculator will allow you to put in a total amount of money, an interest rate, and how many payments, or how much per month, and figure out how long it will take and how much interest you'll pay over time. So in this example, we did the math for you, and we found that if you're paying $150 a month, it will take you about 8 months to pay for this computer. And over that time, you will pay $51 in interest, which is really not that bad. But keep in mind, you were paying a pretty significant amount each month, and you paid it off in a relatively short time, 8 months. And so over that time, the interest that it added up to was $51 in interest. On the other hand, let's look at another scenario where you were only able to make the minimum monthly payment of $35 a month, and the annual interest rate is still 15%. And again, you never make a payment. You pay every month on time, but here you're only paying $35 a month. Let's see how it would work out. So again, we're gonna look at what would the total cost be over time and how much are you paying in interest. In this example, you actually pay a total of $1,245. So you've paid $245 in interest for this $1,000 laptop, which is pretty significant when you think about it. That's basically about a fourth of another laptop. It's a big chunk of money relative to this total cost. And it will take 3 years to pay that loan off if you're only paying $35 a month. So that's the main message we want to convey about the way you use credit cards. Is if you borrow something that you're not going to be able to pay off fairly quickly, you're going to pay a lot of interest over time, because it's 15% is a pretty high interest rate. And really, it's common for people to even have a slightly higher interest rate than that on their credit card. So you really want to be thinking about how quickly the interest will add up if you're stretching it out over such a long period of time. The general rule of thumb that most of us try to live by is to pay off your credit card balance every month in full. That's always my goal. I use my credit card for convenience, but I pay it off every month because I actually don't want to pay any interest. And if you pay it off each month in full, they don't charge interest until you get beyond that first due date for that balance. So you can avoid paying the interest if you pay it off in full every month. And that's really what we recommend. Paying the minimum payments is really risky, but unfortunately, a lot of people end up doing that because they think, oh, I'm making my minimum payment. I'm doing what is required of me. That should be fine. But unfortunately, sometimes with credit cards, the minimum payment, first of all, it will take a long time to pay off the balance. And sometimes the minimum payment is even less than the amount of interest you owe for that month. And if that's the case, you're going to run into this problem that the balance will never go down. The example we ran, the $35 a month was enough to cover the interest and a little bit more. But if you had a larger purchase, like a $4,000 purchase, then paying $35 a month would not even cover the interest for that month. And if you do that, again, that balance is going to go up instead of going down. And that's how people really get stuck, is paying the minimum payment and thinking that that's acceptable because it says minimum. But really that is a trap. There are other fees that credit cards carry. So, and the goal should be to avoid those fees as much as possible. Some credit cards charge you an annual fee just for having that card. So it's a good idea to try to get a credit card that does not charge any annual fee, or be careful about it if you open a new credit card and you know it's going to have an annual fee, because that's going to come up every single year. And it can be $65, it can be $100 a year, somewhere in that range. So be careful. There are some credit cards that don't charge any annual fee, but a lot of the membership cards and loyalty cards with airlines and stores, a lot of those do charge an annual fee. There are also late fees for going over your credit limit. So initially the credit limit might be $1,000 or $2,500. It usually starts pretty low. And if you end up putting more on the card than that limit, there's an over limit fee, and then cash advance fees as well. We tend to point out that credit cards are not all the same. They're like pizzas. You can get different features on a credit card. So it's a good idea to ask around or shop around to find a card that will work well for you. We also generally recommend that you don't want to have a lot of credit cards. And Judge Diehl is going to talk more about how having credit cards impacts your credit score. My general rule of thumb, and I'd love to know, Judge Diehl, what your practice is, I tend to have 2, maybe 3 credit cards. I think it's a good idea to have one of the major ones, like a Visa or MasterCard, which are taken everywhere. And then maybe you want one loyalty card if there's a store that you always shop at. Like I have a Target card because I shop at Target a lot, having young kids. But I think that the problem is every store will say to you, do you want our credit card? And there's benefits and perks, but you don't want to say yes to all of those cards. You want to be careful about that. And Judge Diehl, do you have anything to add about that, about which credit cards to take out? Oh, and I think you're on mute. Just want to.
I'm sorry. When people are starting out, I think it's good to start with one, just because it's easier to keep track of one card. If you've got 2 or 3 different ones and you're putting money on them, it's hard to keep track of how much you actually owe. I do think after you get over that initial hump, that it's good to have a second one, because there are glitches. Machines don't work sometimes, and you may have to pull out another one to make it work. But yeah, you don't need a ton of them.
Absolutely.
Particularly when you're young.
I agree so much. It just makes it harder to keep track of and easier to fall behind, and bad for your overall credit score to have too many of them. And even closing them is bad for your credit score. And we'll talk about credit scoring more later. So then just a few other things. We got some additional resources there that you'll have in the materials. There are other forms of credit. So we've talked about credit cards, but just to touch on a couple of the other primary types of credit that exist, because there's not just credit cards out there. There is long-term credit, things like a mortgage loan, a car loan. Those are usually stretched out over a longer period of time. A mortgage will often be for 30 years or 15 or 20 years. And car loans can be varying lengths of time. The other thing about mortgages and car loans is those are secured credit. So they have a collateral that is put up to secure the loan. And typically that means you get a little bit of a better interest rate than an unsecured loan. Then, of course, there are student loans. And many of you may be thinking about, okay, I'm going to try to go to college. Am I going to take out student loans? Should I be worried about student loans? And, that can be a whole other course unto itself. Yeah. And student loans are important. Going to college is a really good investment, and it can be really worthwhile, but you've got to be careful about it. And unfortunately, student loans can also be a trap, where they're very easy to get. And sometimes people don't think about how I'm going to repay this over time. And student loans are generally not dischargeable in bankruptcy other than unusual circumstances of extreme hardship. So it's a very serious commitment to take those out. And then other types of short-term credit, things you might not think about, like utility bills, your cell phone bill, your cable bill, those are actually credit because you pay them at the end of the month, as opposed to paying at the beginning of the month, like your rent. And so it is a short-term credit, but you're typically paying it off each month. Of course, sometimes people fall behind and it can be a problem as well. And then finally, these other things we wanted to mention: payday loans, pawn shop loans, and car title loans. These are really risky types of credit. They're usually very high cost. And the reason they're so high cost is that they're for a really short amount of time. So typically a payday loan might have like a 2-week term and then it's due. And payday loans are illegal in Georgia, but of course there are certain online payday lenders, and then car title loans similarly are usually for a pretty short duration. And you're putting your car up as collateral for these loans, and they can be very expensive. Usually people use them when they're in an emergency, but it can really lead to a debt trap where you end up rolling the loan over multiple times because it's too hard to pay it off. And it can end up costing you 400% annual percentage rate in the end. So we really recommend avoiding these types of loans. All right.
Okay, now I'm going to talk about credit scores and credit reports. And credit score is something where, just like on your report card, you want somebody to check excellent. And so we're going to talk about what you can do to get an excellent credit score. And we start really at the ground level, which is a credit report. And a credit report is a document that contains your history of borrowing and repayment. It's like an adult report card. You borrowed this much money. Did you pay it back? The credit reports are prepared by businesses that are called credit reporting agencies. And there are essentially 3 of those agencies. Next slide, Sarah. The Equifax, Experian, and TransUnion. And what those companies do is they gather information from everybody that you borrow money from, whether that is a credit card company, a bank, a cell phone provider, and they put it all in a list. So it'll say on there, MasterCard, tell you what the limit is, and then it'll say pays on time or whether you've been late. And it tells how long you've had the card. And so it's a compendium of information about your credit, and everybody contributes to these. You can see your credit report as well. So next slide. There is a website, annualcreditreport.com. And on that website, you can go there and get a free copy of your credit report once a year from each of the 3 credit reporting agencies. So if you were very methodical about it, every 4 months, you could go and get a credit, get Experian today, 4 months from now, get Equifax, 4 months after that, get the other one. And then you can see what's being reported on you. And it's important, and we'll talk about this a little bit more, but you want to make sure they're accurately reporting on you. And so the only way to do that is to look at it. There is another website that I don't want you to go to, which is called freecreditreport.com. Sounds like it's free. It isn't, but it is a scam that tries to sell you. It says, we'll look at your credit report for you every month, every 3 months, but you have to pay them to do that. Just like they say they'll fix anything that's wrong. That is a scam. You don't want to do that. Annualcreditreport.com, check your own credit. So how exactly does this work? Well, if you go into a bank, next slide, if you go into a bank or you fill out an application online for a credit card, you are asking that company to approve you for a loan. And the creditor is then going to pull your credit report, and they're going to look at it and say, aha, this person pays back money that they borrow. So we're going to give them a credit card. We're going to give them a loan. Similarly, if they say you don't pay it back or you don't have sufficient history, they may decide not to give you money. And then the third thing, and in the purple box, this is important, the interest rate they charge you can be different. Sarah talked about what the average interest rates on credit cards are, but they vary from person to person. They can change during the course of time that you hold the card. So the better your credit rating is, ultimately, the lower the interest rate you're going to have to pay. So it is very important. Next slide. So that's a credit report. So that's the long form, lots of information. A credit score is just a number. It's just like your GPA, just one number. And it is a number that is between 300 and 850. I'm not sure whoever came up with that. Well, I do know it was the Fair Isaac Corporation. That's why it's called a FICO score. But why that range, I don't know. Why not 100 to 500? I don't know. But it's 300 to 850. And your score, and we're going to talk about next what goes into it, but the credit card, whoever wants to lend you money is going to look at your score and figure out whether you're bad, fair, good, or excellent. And that's going to have a big difference on whether or not you're going to be able to borrow money and how much it's going to cost you to borrow it. If they do turn you down, they do have to tell you why they turned you down. But if your credit score is bad, that's enough of an answer. Your credit score did not meet our parameters. So how do you get this? Who's a 300, who's an 850? So there's a pie chart that shows you in general how this is used. And you'll see the biggest chunk there, the blue slice of the pie, is your payment history. That is looking at when you have borrowed money before and whether you paid it back in a timely manner according to what you promised to do. So if you're late, that comes off of your pay. That's not a good thing. That's going to be in your payment history. The next biggest slice is how much you already owe. So this makes a lot of sense. If you've got a person that has the capability of paying back, let's say $10,000, if they've already got $10,000 worth of limits on their credit cards, you're not going to want to lend them anymore because you're probably not going to get paid back. So the amount that's owed is important. Then we've got two 10% things, the types of credit used. Something like a home mortgage loan, they do a lot more investigation because it's a bigger amount of money. It is collateralized, but that's a different type of credit than a Visa, MasterCard, American Express, which is a little bit more sophisticated than store credit cards. As Sarah said, you go into a store, every store you buy from, they're going to ask you, do you want a credit card? They're very easy to get a credit card from. And for that reason, when they're looking at the type of credit you have, they don't mean very much to a lender because they know there wasn't much investigation there. Then new credit. This means if you are going around trying to say you filled out 5 credit card applications online today and you tried to get new credit, the people looking at it are thinking, because they'll see how many inquiries, your credit report also shows how many people looked at your credit report, meaning how many people were thinking about loaning you money. And so if you're one of the last ones to come in on that, you're thinking, whoa, why is this person trying to borrow money from 3 or 4 or 5 different sources? They must be in trouble. I don't want to be in trouble with them. So that affects it. And then finally is the length of your credit history. And, this is something that when you're coming out of high school or college and just getting your first credit card, you can't do a whole lot about because your credit history doesn't start until you obtain some credit and pay it back. Some people say that that's a good reason to, once you get your first credit card, keep that credit card, even if you're not using it significantly, because you'll have a history there. As you get older, that will make a difference. If you have had credit and been paying on your bills for 20 years, that's going to mean a lot to somebody who's going to extend you new credit. Okay, so that's what's in your credit score. What can't be used in your credit score? Demographics, so your age, race, religion, gender, sexual orientation, family obligations, national origin, marital status, that can't be used. And it's important to know that it can't be, because if you're denied credit and you ask why you were denied credit, if the answer comes back, it's because you're, a 17-year-old girl and we don't loan to 17-year-old girls, they've got a problem, not you. This is stuff they're not allowed to use. Similarly, they can't use your employment information, how much you're making, your occupation. And it's also important that if you make payments with a debit card, that doesn't go against or for your credit score, because it's not a borrowing, like Sarah said. Similar, when you're paying cash, that doesn't make a difference. Okay, so what can hurt your credit score? Mostly it's the inverse of what we discussed that can help you. History of late payments, short credit history, too many credit cards, and having no credit. So the first time that you go in to make a borrowing, they're going to try to pull up your credit history and you're going to have none. And that can cause an issue. Actually, my younger daughter, when she tried to lease her first apartment after she was out, she'd never had a credit card, tried to lease her first apartment, the landlord said, "You don't have any credit history. I can't loan to you." So of course she calls mom and we get it straightened out. But you have to start somewhere. And sometimes that it's possible, if you go to a bank and you don't have a credit history, you can say, okay, I'll put $500 in my savings account. And then can you give me a credit card with a $500 limit? So you're basically collateralizing that. The bank's not going to lose money because they're sitting on your savings account. But if you use that card, just charge $50 a month and you pay it back every month, you're developing a credit history. Too many inquiries, as I said earlier, and this, a high proportion of revolving balances to credit limits. So what this means is if you have a card and they give you a credit limit of $1,000. Why did they give you that limit? Because when they looked at whatever financial information you gave them, they determined that that's how much you could pay back reasonably over time. So if you go to the full credit limit on that, anybody else wanting to give you credit is going to think, oh, they're not going to be able to pay it back because look, they're already using 100%. So the rule of thumb, they say, is don't use more than 25% of your available credit at any one time. And you do that by paying the bills. If you keep paying the bills in full or as close to in full as you can, you won't have a problem with this. And then, of course, the worst thing is if somebody sues you for not paying, there's a judgment against you, or heaven forbid, you have to file bankruptcy. And those kind of things, judgments, bankruptcy, they stay on your credit report for a long time, 7 to 10 years. So it's not that you can make a little mistake and just walk away for it. It stays with you. If there is something inaccurate on your credit report, or let's do the key takeaways. I jumped, I'm sorry. There's a lot on your credit report, so I encourage you to read it. And it's not just lenders. As I said, landlords do it. Employers may look at your credit history. And why would they do that? Because it's sort of a record of your responsibility. If you're living up to your obligations on your credit cards, the potential employer is thinking, oh, this is a responsible person. They will do what's in the interests of the company or whoever else they're working for because they're responsible. Okay, disputing. Next slide. If there's something wrong on your credit report, you have a right to dispute it. And you can call them, but you should put it in writing. If they have on your report that you were late on such and such a payment and you weren't, you need to tell them that. You could also call the creditor and say, it must have gotten lost in the mail. And if it's the first time you did it, the creditor may do you a favor and take it off your credit card, but you have the right to do that. So how do you manage these things? The first thing is check your credit report every year, but also check your credit cards. Everything is managed online now. So if you have a credit card, you can get an app or you can go to that company's website and check what's on the charge card. And if you ever see a charge that you didn't make, jump on it right away and try to figure out how did it get there. If it's on there and you didn't make it, dispute it. You really need to, particularly when we're talking about the idea of identity theft. You've probably heard that term, but it's really fairly common. And what happens, next slide, Sarah, what happens is that another person uses your name and social security number to open an account. And then they're using it and they're buying the stuff, but the bill is coming to you. And you're not going to find that out unless you're checking your credit report, because of course you don't have the credit card, and maybe they're not sending the bill to you. They don't want you to know they're charging up under your name. So you need to jump on it with the actual issuer of the credit card. There's also using another person's existing accounts. I hate to see this, but I've seen it a lot in bankruptcy court, where it's relatives and good friends that do this to each other. And so you really got to make sure that you watch all this, and keep good records. I think most people now tear up their credit card receipts and get rid of them. When you're starting out, you shouldn't do that. You should keep track of them and compare them to the bill when you get it, at the end of the month or whenever you get it. Okay, so how do you prevent that? As I said, look at the statements as soon as you get them, but I would go further than that. I would look at them weekly online, because you can now. It's like it used to be, you had to wait till they sent you something, but now you've got it. Dispute, if it's not your charge, dispute it with your credit card company before they report it to the credit reporting agencies. And I think most of them, you've got to dispute within about 60 days of when they send you the bill, or you will be responsible for it. So if you have any suspicion that somebody is using your name, your numbers, you got to act fast and you got to get on it. Okay, Sarah.
All right. And there are some links you can follow to get more information about these and other topics. So let's talk a little bit about saving and budgeting. Of course, this is really the antidote to ending up in too much debt. What you want to do is have a good monthly budget and stick to it and save ahead, so that when you need to make a big purchase, you can make it from your own savings instead of relying on credit cards and other loans as much as possible. And so it's about learning to live within your means, within your monthly income, understanding the difference between wants and needs, and budgeting carefully. So let's talk about how you do that. Budgeting involves keeping track of how much money you make and how much money you spend, and making sure that you're making more than you're spending, not the other way around. And ideally with a little bit of a cushion, because that cushion will become what you're saving. One really important concept to understand in budgeting is your gross income and your net income. So when you get a job, you're going to have your gross wages, which is the total amount that you earn, but your employer will take certain deductions out of that amount. Things like your federal income taxes, state income taxes, healthcare, monthly costs, things like that will come out in your deductions. And then the amount you have after that is your net take-home income. And that's really what you have to work with for your monthly expenses. And so we have here a kind of a rough list of expenses. I'm not sure where this imaginary person lives, because rent of $500 a month, utilities of $40 a month, really pretty impossible by today's standards, but you get the idea. There are all these different items that are part of your monthly expenses. And in this scenario, the example person we're looking at has $1,700 a month of net monthly income and $1,600 of expenses. So they're doing okay. This person is living within their means, but they can't afford to save very much. And so ideally, this person would want to decrease expenses or increase their income in order to be able to save more regularly, a little bit more than $100 a month. I think the hardest thing about budgeting, really, there are two things that make budgeting hard. One is it's really hard to think about all of the different expenses you might have. This is a really limited list, but there are tons of things. You've got all these monthly streaming services, subscriptions and memberships. This says insurance, but you're going to have car insurance, probably also life insurance, homeowners insurance. If you own a home, that'll probably be part of your mortgage payment. But there are other things like maintaining your yard, pest control, your cell phone, internet, cable. There's so many different things, and it's really hard for any person to sit down and think of what are all the things I spend money on. But there are some resources you can find online that will help you think of all the categories of expenses that you want to think of. And the other thing that's helpful is if you use either a debit card or a credit card to pay your regular expenses, then you can really analyze at the end of the month, where did my money go? It's much harder if you're paying with cash. So if you go take out $200 cash from your ATM and spend it on various things, you have no idea what you spent that money on. So if you're doing a budget, it can be helpful, even if it's a debit card. If you use your debit card routinely, then at the end of the month, you can look at that statement and you can see, okay, I spent this amount on food, I spent this amount on entertainment, and your bank will even do little summaries for you that makes it a lot easier. So to make your budget work, you've got to balance what you spend and what you make and be making more than you're spending. Sounds easy. Yeah, but we know it's often not that easy in reality. So the goal is to check your budget periodically and make adjustments where you need to, and look at, where can I reduce my expenses? Can I not get my Starbucks coffee, but instead bring my coffee or bring my lunch from home? Can I get cheaper internet? Can I, shop around for things like car insurance and other things? So always trying to keep an eye on those expenses and bring them down, and look for ways to increase your income whenever possible. And really asking yourself, do I need this or do I want this? That's an important part of the process. And then stick to your budget. Obviously, you have to be flexible. Things will change over time. And there are certain expenses that are not the same every month. So typically in the winter, your gas bill will be higher. And in the summer, your electric bill will be higher when you're running the air conditioner. And usually people will take an average for those types of expenses, but you're going to know that there's going to be some ebb and flow in different months. I have a household budget that we use. I try to revisit it every 6 months. I think that's a good practice, and keep an eye on where things are going. And then try to build into your budget a certain amount of savings. And it's hard to say how much that should be. I think that's different for everybody, but you should always try to increase it over time and save as much as you can, especially when you get a higher paying job. Okay, if you're bringing more money in, trying to really build in as much savings as you can. Savings accounts are basically the flip side of credit cards as far as compounding interest. So in this, when you have a savings account and you put money into it, or other investments like index funds and things like that bear interest or that give you a return, that money will grow over time. And so what we're trying to show you with this example is that if you save $100 a month for 12 years and you're making 5% interest, so that would be something like an index fund or some other investment, not like a typical savings account. But there are certain investments that will give you a better return, retirement accounts, things like that. Then ultimately, if you, so in this example, if you saved for 12 years and you were earning 5% interest, then your savings at your final age would, at age 30 in this example, so I guess this is from age 18 to age 30, you've now got $19,678 in your savings account. And I'll tell you that for 12 years here, you would have put aside only $14,400 in your actual taking money out of your account. So you earned about $5,000 in interest. But if you save that amount over 47 years, you're going to earn even so much more interest. And because every month the interest you earn gets added to the balance, and then you earn interest on that interest. So in this example, if you saved for 47 years up till you were age 65 and you were putting aside $100 a month, well, you've paid in about $56,000 over that time period, but you've gained about $170,000 in interest that was just growing and growing over time and compounding. So it's really, these examples seem almost magical, but this is the way compounding interest works. And then similarly, if you saved $150 a month for 47 years, then you end up earning about $255,000 in interest for a total of $339,000. So in that third example, your money is only $84,600. That's that number of years at that amount per month, but then everything else in there is interest. So just keep in mind that you want to start saving as early as possible. If you start at a young age, it will grow so much more than if you wait until you're 40 or 45 to start saving. So really start saving now for as soon as you start working. Ideally, you want to start saving for retirement, college savings account for kids, things like that. So it is the earlier you start, the more it will grow over time. All right, I think we're ready for a wrap up and a little quiz here to see how everybody understood. So Judge Diehl, I'm going to ask you the first questions. True or false that you pay no interest on debit card purchases?
That is true. And
There
of
you
course, the reason for that is you're not borrowing any money. You're taking your own money out of your bank account. So you wouldn't pay interest for using your own money. Okay, Sarah, true or false? There is a credit report for everyone over the age of 18.
So that is false. I know that some people don't have a credit report. You only have a credit report if you establish a credit history. And there are some folks that we describe as being credit invisible because they've never opened any credit account. So they have no credit score and no credit report. So that it is an important thing to build a credit history over time. And there are some ways to establish a credit history. I know, Judge Diehl, you referenced getting a credit card from the bank where you have an account. There's also secured credit cards. And so there's different ways to establish that history over time. Let's see, I'm asking you this one. If you are late, true or false, if you're late making a few payments on your credit card, the interest rate you pay may increase sharply.
And that is unfortunately true. Of course, when you get a credit card and they send you the card, it will come with about 10 pages worth of teeny tiny print that explains everything about the credit card. And one of those is that if you default on the credit card, meaning you don't pay it within the time they told, make the minimum payment within the time they told you, your interest rate can go up. And it's even true that if you have more than one card and you default on one, the interest on your other credit card might go up. So it's very important to make your payments on time. Okay, Sarah, if you miss just one or two payments, it won't really hurt your credit rating.
So that is false. I know that negative information like late payments or missed payments has a significant impact on your credit score. And that type of negative information can stay on your credit report for up to 7 years. And as you mentioned before, things like a bankruptcy filing can stay on for up to 10 years. So that information remains with you for a long time. And it's really important to keep up your on-time payments. Okay, true or false, no one really looks at your credit report.
Well, that is false, at least if you're out in the world living a life where you have to borrow money, go to a landlord, get a job, almost anything you do, I think now even to open a bank account, they will look at your credit score. You can be sitting at a desk with money to put into an account and they want to make sure that you're not going to overdraft that account immediately. So almost anything you want to do where you're interfacing with a third party that's not a personal friend, they're going to be looking at your credit history. So the answer is get credit smart. And we hope we've helped you with that today.